Okay, hi guys. Today I'm going to show you this thing which can help you to achieve financial freedom, which is called the wealth planning model. Okay, this is presented by me. Okay, I'm qualified to show you this because I got a degree in finance and I got a merit in finance. Okay, so without further ado, okay, I shall show you what this wealth planning model is all about. Okay, every month you receive a salary. This is called your active income. Okay, so for example, let's say you get 4,500 monthly salary. So after you get your salary every month, it will go next to your expenses. Okay, so do you know what types of expenses are there? Okay, basically there are two types. One is the fixed expenses and the other is the variable. Okay, so what do I mean by the fixed expenses? Okay, for example, for your bills, for example, the bills of your utilities, which is your electricity or gas, your housing loan. If let's say you are still paying mortgage, okay, your food, your transport, children tuition fee, all these. Okay, these are called fixed expenses because most of the time they are of a fixed amount without much variation. Okay, so the second one is variable expenses. For example, let's say your friend's wedding, then they invite you, okay, or your family members, relative, newborn. Okay, so this is like the extra expenses. Sometimes you need to buy some gift for them, or you need to let's say for the Chinese, they need to give a red packet, or it's also known as a ang pao. Okay, so basically these are the main two type of expenses. Okay, so typically to be financial to have financial prudency, okay, it is best to keep within 45 to 60%. Anything higher than 60%, it is deemed unhealthy. Okay, or anything that is below 45% of your active income, it is very healthy, and keep it up to keep your expenses as low as possible. Okay, okay, so next, after your expenses, okay, what you need to do, basically you got to protect your wealth. Okay, so for example, you have heard the story of the goose that lay golden eggs. Okay, so my question to you is, would you rather protect the golden goose or the golden egg? Okay, so of course we got to protect the golden goose. Okay, because so that the golden goose will keep on laying golden eggs. Okay, so it is the same for example for you and me, because we work for a salary. Okay, so we got to protect ourselves. Okay, so that our income will keep on coming in. Okay, so how do we go do wealth protection? Okay, basically there are three tanks. Okay, and inside these three tanks there are three D's. Okay, so the first D is you got to protect your life. So for example, you have dependents such as your parents or your children. Okay, touch wood, if anything happen to you, you no longer receive your monthly salary, but then the payout from your claims from your life policy can use to provide the financial needs for your family and for your loved ones. Okay, so this is achievable by purchasing a life insurance. Okay, and next is diseases. Okay, so sometimes we do fall sick, and it might be a light diseases or a heavy one. Okay, light diseases might be flu or cough. Okay, but the heavy one, sometimes you need a lot of money to for your hospital bill, which is so therefore you need to protect your health. Okay, this can be done through purchasing a health insurance. Okay, touch wood, anything happen to you, if you are hospitalized, at least you have a daily income, and your hospital bill will be covered. Okay, so the last one will be damages. Okay, so beside that, you need to service your loan for your housing. Okay, some of the damages includes car. Okay, your car insurance is a must. Okay, without it you cannot drive. Okay, it's illegal to drive without a car insurance. Okay, so this is to protect your wealth. Okay, so typically what you need to do to take note is you spend about 5 to 10% to protect your wealth. Okay, 5 to 10% of your active income, use it to protect your wealth. Okay, so after you have done your wealth protection, okay, of course you need to accumulate wealth, let's say for retirement or for the things that you would like to achieve. Okay, so before you accumulate your wealth, make sure you save up to 3 to 6 months of emergency fund, because just in case that you are out of job, okay, and then you need to spend some time to look for another job, okay, or touch wood, let's say you are unable to work, due to some unforeseen circumstances, and these 3 to 6 months emergency fund can help you to tide through this tight period. Okay, so after that, the next box will be the accumulation. So inside this, you can accumulate wealth to further your education. You can accumulate wealth to purchase a car. Okay, or you can accumulate wealth to buy your first house or your second house, or even you can use it to go for holidays. Okay, so what are the types of wealth accumulation? Okay, basically there are two types. One is known as progressive, another is known as systematic. Okay, progressive means that if let's say every year, your company will give you a pay rise of certain percentage. Some company give about 5% increment, some give up to 10 or even more. Okay, this is known as progressive. So you can basically, if let's say you are maintaining the same lifestyle, you can use the extra cash to accumulate your wealth. Okay, systematic is like your CPF. Okay, and because every year your ordinary account they give you 2.5%, and your MediSave account and your special account give you 4% interest. Okay, so this is known as systematic wealth accumulation. Okay, so the last one will be wealth acceleration. So what are the wealth acceleration instruments? Okay, some of them are shares, bonds, let's say land banking, or wine investment. Okay, but of course to do all these investment, you got to have some knowledge in it. So if let's say you don't have knowledge in this area, please do not touch all these instruments, especially some of those people who invest in share. Okay, rather than invest, they are likely a trader. Okay, they do trading rather than investing. Okay, so okay, typically what you need to do is you can use 20 to 30% of your active income to do wealth accumulation. Of course, the higher the better, and the lesser the it will. If let's say you accumulate wealth below 20%, it is you got to adjust some of your expenses so that you can accumulate more wealth. Okay, so inside these three tanks, okay, basically somehow or rather it will give you passive income. Like let's say for your emergency fund, let's say you put into the fixed D or even a saving account, it gives you some form of interest. Okay, so when you accumulate your wealth, let's say you buy an endowment, okay, you also give you maybe 3 to 6%. Okay, depends on what kind of endowment plan. Okay, for share and bonds, they give you dividends and coupons. Land banking, they give you some interest. Wine investment, capital appreciation. Okay. So if let's say all these passive income, if let's say you accumulate wealth until it becomes so big due to compounding, okay, one day it will become more than your active income. So when it become more than your active income, okay, am I right to say that this the whole wealth planning model, the whole system will sustain by itself? Okay, so when you have achieved this, basically you have achieved financial freedom. Okay, and most of the financial consultant or financial advisor will stop here. However, this is not the final the final planning. Okay, so after you have achieved this financial freedom, basically what you need to do is to plan for wealth distribution. Yes, wealth distribution. Okay, so same thing for the wealth distribution. Inside there are three tanks, and the first tank is who. Okay, who would you like to pass your wealth down to? After you pass on, whatever asset you have will become an estate. Okay, okay, just a different term. When you're alive, it is known as an asset. Okay, so basically after you pass on, it will be known an estate. So who do you want to pass down your estate to? Okay, it can be your parents, your loved one, like your children, or anybody else. Okay, and what would you want to pass down to them? It can be your investment, your share or bonds, or you can even donate to any charity organization. Okay, okay, so it can be your properties, so you can pass down to anybody. Okay, so so the next one will be when. Okay, so when do you want to pass this when do you want to pass your estate to your loved ones, or let's say charity organization? Okay, so this can be done through drafting a trust. Okay, it can be done through lawyer or attorney. Okay, so basically this is the whole concept of a wealth planning model for you to achieve financial freedom. Okay, so if you like to know to do your personal finance, basically you can look for me by clicking on the below link. Okay, alternatively, for this for any financial advisor, okay, basically they can purchase this PowerPoint at the below link also. Okay, so if you find this video beneficial to you or informational to you, please share it with your loved one. Okay, and thanks for watching and listening.